Good morning, everybody. Sorry, I'm just having a couple of little technical problems, but we will start in a minute. Just trying to get my second screen working. Can everybody see my screen okay? If you wouldn't mind just popping in the chat box so you can see my screen okay. Thank you, Erin. Fabulous. Right, I think I've got this all working, although I'm working with a second screen for the first time, or second time technically, because we did it at the our planning day the other week. So I'm trialing it for the first time in a webinar today. So apologies in advance if anything doesn't quite go to plan. And also as well, I just need to caveat, I'm half expecting a call from my son's school because he's not 100%, but bless him, he's trying at school. But obviously if the school call, I may need to just stop for a few minutes to take the call. So if that happens, apologies in advance. But anyway, welcome to today's webinar. Thank you very much for coming. I know your time is precious, so I really do appreciate you joining us today. Or for anyone who is watching on recording, again, I appreciate you taking your time to watch the recording. For those of you who don't know me, I'm Cheryl Sharp. I'm the CEO and founder of Pink Financials, and we are an accountancy practice for business owners who want to do more of what they love with who they love, and we help them to get there. So to start today's session, I just want to share with you a thought for the session. The budget is not just a collection of numbers, but an expression of our values and aspirations. So hopefully you all have a budget and a forecast to reflect the changes since the last couple of years, and hopefully you're forecasting for this year, especially things to massively improve on the last couple of years. But now it's time to really understand, make sure that you can understand, monitor and measure what you've set in those budgets, and that you understand as well what's going on in your business from the numbers perspective. So this webinar is all about demystifying the most common reports that you'll see, so especially those in your annual accounts, but also what you should be looking at on a weekly, monthly and quarterly and annual basis, so that you are in control of your business performance. So this is what we're going to cover over the next 45-60 minutes. We're going to cover the importance of knowing your numbers, an overview of some of the different reports that you should be producing, and the main ones that you should, the difference between profit and cash, the key drivers of your business value, how to protect your assets, and how to adopt best practice. And then we'll outline some potential next steps for you to take to make sure that you truly do understand your numbers. So please take, sorry, I'm just trying to rearrange everything on my desk because I feel like I'm constantly looking down here rather than looking at you, because this is where my notes are. Sorry. So yeah, so please take plenty of notes throughout the session. Some of what I talk about may sound a bit like foreign language with some of the account stuff, so it's what we call accountanese. I'm going to try and keep that to a minimum and try and explain terms as and when I can, and when we come to them. Ask any questions as we go through. Feel free to pop anything in the chat box, and we can answer questions as we go through, or I've got plenty of time at the end as well. Fab, so let's get going. So why do you need to know your numbers? Well, knowing your numbers is vital, as it allows you to really interpret your reports and know that you're on track to achieving your goals set out in your business plan, or your or if you've got one, or like a recovery plan, to make sure you're going in the right direction throughout the year. So here's my top 6 reasons why you need to know your numbers. First of all, they tell a story of your business. So it allows you to interpret the results of your business activity. This will then help you to identify the symptoms versus the root causes. For example, a decline in gross profit is a symptom of many root causes such as ineffective pricing, rework, poor purchasing, wastage, and so on. Knowing your numbers will enable you to spot an early warning sign of a potential issue. For example, monitoring how long it takes customers to pay you. And that will allow you to quickly respond if you see that number start to increase, so they start taking longer to pay on average, and things like that. It will also identify areas of strength and weaknesses. So, for example, if your balance sheet indicates whether your business value is going up or down. Understanding your numbers will also mean you have reliable financial information to base your decisions on, so you can make better decisions for your business. And finally, we've all heard the saying, knowledge is power. So the more you know about your business, the better your business will be. So these are the reports that we're going to go through today in a lot more detail. We're going to review each of these reports to help you understand what you can learn from them. And these are mostly the reports that you will see in your year-end accounts. And I'm going to show you some of these, explain in a lot more detail what they're all trying to say to you. Obviously, throughout this, I'm going to be using fictitious demo data. So it's never going to be real company's data that I'm sharing. So first of all, we've got your trading account, and this tracks your sales and your variable costs, giving you your gross profit. And what this does is it helps you to calculate the return you're achieving before you're deducting your fixed overheads. Your gross profit percentage indicates whether your margins are improving or deteriorating. And you can also track your results across different divisions or product lines or different locations, depending on how your business is set up. So for example, if you're a business that's got a couple of different offices, so say you are, I'm just going to use Greg's for an example because I saw Greg's something earlier. There's loads of different Greg's. So if you had a business like that where you had 3 or 4 different locations, you can look at how each location is doing compared to the other, as well as overall. And it allows you to track how each location therefore is performing. And some small adjustments in the items in your trading account can actually have a huge impact on your overall results, which is what I'm going to show you or explain to you now. So this is the trading account, and it's the top half of your profit and loss report in Xero. So, and it's the top half of your profit and loss report in your year-end accounts, and in the other profit and loss report that you run as well. So what you can see here is you've got the sales of 26,367, less purchases of 1,950, which then gives you the gross profit. So the gross profit, as you can see here, is your sales less your cost of sales. So your cost of sales is all the costs that are directly related to your sale. So in this case, we're thinking a food shop. So the purchases is the food that is bought to resell. It could also be that your business is an electrician. So your purchases could be the materials that you use in your jobs. It could also be, you could also have a second line in here for your direct labour or your direct wages or subcontractor. It all means the same thing. It's somebody that you pay that's not employed by your business. It's a subcontractor that you pay to deliver your service or your goods. So for an example, going back to the electrician one, it could be your apprentice, it would be apprentice because it'd be employed, sorry, a subcontractor that you ask to join you on certain jobs to fulfill the work that you need to do. And this is what gives you your gross profit margin. So your gross profit is always going to be your sales less your cost of sales. So for this business, it is gross profit margin, and I've just worked that out completely wrong. is 92%, this one here, because he's got a very high profit margin because his cost of sales are quite low. And this is what we would see for many services businesses. You'd have a very high gross profit percentage because you don't have a lot of things to pay for that is based on delivering your product or your service. If you was in a industry where you was buying goods in to resell, we'd expect the gross profit margin to be a lot less, so potentially 50% or lower. So it all depends on what industry you're in as to what a good gross profit percentage would be for you. And this is one to track as well. So as you grow your business, it's one to track so you can make sure that your gross profit is always at a steady level, and then that will help you in future to work out a budget for your sales, because you'll know that you need to achieve a certain amount of gross profit to keep on a par. And it could be as you grow and you start asking people to come and help you to deliver your service, that your gross profit will take a dip for a while and then it will start to improve again. And it could be that the more people that you ask to help you in your business as subcontractors, that your gross profit will reduce as a percentage, but obviously as a monetary value it will still improve because you're bringing in more sales. So these are things that you will learn, and you will understand how your business works with regards to your gross profit percentage. So it's something that you should keep an eye on, but obviously there's going to be different reasons as to why it fluctuates. So it's understanding those reasons as to why it fluctuates. And then you'll start to understand if it's a good thing or a bad thing that it's fluctuating. So then the second part of the profit loss is also known as your income statement. And this part is the bit that tracks the rest of the performance of your business. So it matches your income and your expenses for the period with adjustments for timing differences, for example, sales that have been made but money that hasn't yet been received and things like that. So we'll talk a little bit more down the line, but it's important to remember that profit is not the same as cash in your bank. So the profit shown on your profit and loss statement includes a lot of non-cash expenses such as depreciation and adjustments. But you must ensure that you've got enough profit to cover all your cash costs as well, such as loan repayments. I know a lot of people have got bounce back loan repayments at the moment, so they're not going to be shown in your profit and loss. And again, as I said, we're going to come through to that in a bit more detail shortly. But your profit and loss statement will provide a framework to benchmark your results, and you can use percentages or comparisons between year on year as well as looking at similar businesses in your industry. Businesses are also generally valued using a multiplier of your earnings. So your profit and loss is one of the drivers for business value as well. So it goes without saying, the higher your earnings, the higher your value. And we've all seen on Dragon's Den, I'm sure, these people come in and say they want X amount of money for a very small percentage of the business, and then the dragon's eyes pop out of their heads when they say they haven't even made any money. And that's why, because it's looking at your profit, and it's a multiple of your profit generally that will drive your business value. So obviously if you don't make any profit, your business doesn't have any value to it. So that hopefully will make a little bit of sense now, and you can probably, if you do watch Dragon's Den like I do, and I love it, you probably understand a little bit more now about why they go so mad. And I really don't understand why the business owners go on there with these business valuations, because if they understood their accounts, they'd know that that's not a feasible number to suggest. So I'm hoping I am with you all and that all makes sense so far. So let's take a look at profit and loss, or the other half of the profit and loss. So you can see that it starts at the top with your gross profit from the trades and accounts section, and then it will start to list out all of your admin costs to give you your operating profit. Now, the one thing that bugs me in Xero is that your corporation tax as standard will show up here. So you need to change the layout to drop it down to be under the taxation, and then it will show you before and after tax. In this fictitious account, corporation tax yet hasn't yet been sorted, so there's no corporation tax showing because this is just partway through a year. But if it once it got to the end of the year, the corporation tax would be in a line just under here, under the profit on activities before taxation. You'd then have the tax line, and then you'd have profit after tax, which would be your profit after corporation tax. And the profit after corporation tax is what is then available for dividends, because your dividends come out of your profit after tax. So that's a really key one for you to look at. And as a rule of thumb, you can always, if you're looking at this throughout the year, you can just come to your profit. You see it's just under 7,200. Currently, if you just times that by 19%, that will give you your rough corporation tax. It won't be spot on because there's adjustments and things, but it's a basis that you can use as a very quick calculation. So in this case, the corporation tax is just under 1,370. So that will leave you, oops, see, that'll leave you round about, or just over 5,800 for dividends, which you can take throughout the year, obviously. So you just need to take into account any dividends you've already taken as to what you've got left that you can take. So what you can do here is you'll be able to see all of your expenses. You can compare them either on a monthly basis, or you can compare them on an annual basis to see what's going up and what's going down, what's staying around the same level. In Xero, it's really handy because where they're blue, it means it's hyperlinked, and if you click on it, it will take you through to a breakdown of how that's all made up. So one thing to look at on here is definitely compare month on month, but also I'd compare these year on year as well, so you can understand if they're going up year on year, going down year on year, and also with the monthly as well, if there's any monthly spikes. And then you can look into it further to understand why it's spiked or why it's increased, why it's decreased. Obviously, some certain things that you will know straight away, like if you've got a marketing campaign and you see that spike, you go, oh, yep, that's when we did this for the marketing campaign. So you'll know what that is and why that is. But it could be you're looking at your stationery and you're like, that's just creeping up and up and up. What's going on there? You can look into it and understand where you're spending money. Do you need to spend that money? Can you stop spending it? Is it justifiable? And you can look into it and just generally understand where your money is going. Subscriptions is a really good one to keep an eye on, because depending on how you put your software subscriptions, for example, a lot of people will put them under subscriptions. We generally put them in IT and software, but it depends on how you like to look at them. But that's something that can quite easily get out of control, and you sign up and sign up and sign up, and you forget you're even paying for some of these things. So that's one that you can keep an eye on and look at and think about where you can get rid of the subscriptions you don't really need anymore, the ones that you're not using, the ones you signed up to and said, oh, I'll use that every day, I'll use that every month, and then down the line you've forgotten you're even paying for it. So that's a really good way of doing it. So one thing that we can do as accountants as well is, or even use a business owner, is you can undertake a review of your expenses, and you can identify some potential savings like we just talked about, where you can look at where things are over and above. And it could be that you contact an insurance broker, for example, or your landlord, and negotiate a 5% reduction. Where you're seeing things that are quite expensive and going up, you can do that. But in here, you can really start to understand exactly, as I said, where your money is going. And from here, you'd be able to put together some kind of budget of what you want to be spending on these things every month. What is a fair amount to be spending on every month? And that's when you can start to really understand what it costs to run your business month in, month out. So you know that you need at least X amount of money to run your business. So for example, in this one, looking at this, it needs at least £17,200 a year, this is a year-to-date one, to run the business. And that's what you need to achieve in sales before you even think about a profit for you as a business owner to take out. Well, so that's your profit and loss. We're going to move on now to the balance sheet. The balance sheet is also known as your statement of financial position, which is the new term that they come up with. Actually, just when I was training, they decided they was going to change the names of everything, and statement of financial position was the new name, but everyone still calls it the balance sheet. And what this does is it provides a snapshot of your financial position at a specific point in time. So depending on the size of your business, depends on how often you should be looking at this. I would say for many businesses, small businesses, once a year, depending on what your goals are, once a year when you do the accounts is enough. But it could be, depending on if you're trying to achieve a certain goal or something, you may need to look at this more often. And what it does is it measures the net worth of your business, which is your assets less your liabilities. It shows if your business is solvent, and by solvent it means, does your business have enough money to continue trading, or is it running at a complete loss? If your liabilities, so what you owe, is greater than your assets, which is what you earn or what's due to you, then your business is insolvent and urgent action is needed to fix this. It could be that it needs some cash injection. I know over the last couple of years, especially, a lot of businesses have been insolvent because they've owed more, because things have not gone to plan, shall we say. And it could be that your business hasn't had the reserves to cover the slack. You've taken out loans, you owe money and things like that. So it could currently be shown as insolvent, and it's not always a reason to panic. It's not always a reason to worry. It's just important that you understand where your position is so that you can deal with it and you can move on and you can sort it out, basically. So we have seen, especially in the last few years, a lot of businesses have become insolvent due to the circumstances, but they're working and they're trading and they're getting themselves out of this situation. So as I said, a lot of businesses at the moment are in that sort of position, so it's not something to panic about if you see it, and it's just something that you need to be aware of and have a plan to move forward. You can then also compare different periods in time to see whether your business's net worth is increasing or decreasing between the years, and you can track the strength of your business. So the stronger your balance sheet is, the easier it will be for your business to survive in a downturn. So for example, those who had high reserves, had lots of money in the bank, have potentially found the last couple of years a bit easier because they've had the money there in the business to deal with it. So in that case, we'd say the business is stronger because it's got the funds to deal with things like what's just happened. Fingers crossed we'll never have what's happened again, but you could still have downturns, especially if your business is a seasonal business. So it's important to build that strength up in your business to make sure that you are preparing for any potential downturns down the line. It could just be that you've got a drop in sales for trends change or something changes down the line and things aren't going quite as according to plan. But if you've got that strength in your business, then you'll be fine. So sorry, it feels all a bit doom and gloom, doesn't it? But I'm just trying to help you to understand what it's trying to tell you, the balance sheet is trying to tell you, and how it can tell you these things potentially before you need to know them and before it's going to cause a problem. The balance sheet also is basis to calculate some key ratios such as debtor days, which is how many days it takes your customers, your debtors, to pay you, and also inventory days. So if you're a business that holds stock or inventory, how many days your money is tied up in that stock. So how many days it takes for you to realise that it's still a Cantonese. How many days it takes for you to get your money back on that, and obviously make a profit on that stock. So let's have a little look. So at the moment, you can see here that this company is currently insolvent, as it has more liabilities than it does assets. So you can see there that the total assets are 548,000, but the liabilities, so what you need to pay, what's owed, is 853. So the net assets, as you can see at the bottom and at the top for the equity, is minus 305,000. So if working capital is also, and this company has also got negative working capital, as its current assets of 138,000 are less than the current liabilities of 162. So when we say current, that means something that's going to be either paid to you or by you in the next 12 months. So current is short term and non-current is more longer term. I hope that makes sense. So basically what this is saying is the company cannot pay short-term debts from the company from the limited cash in the bank, debtors, so what's owed to them by their customers, and stock that is got within the business. So action is needed to get this sorted, basically. And what it's saying is that the business needs an injection, so money in, of about £305,000. So this could be in the form of a loan, overdraft, or it may need to raise some funding, shareholder funding or something like that. So assuming this company can resolve the solvency issue, there are some other areas for improvement too. So I'm going to take you through some of those. So over the long term, the company could implement some strategies to reduce their debtor days and inventory days. So I'm just going to take you through what those are. So you've got your debtor days is your debtors. So debtors are the people who owe you money, so your customers, and they're debtors because they're in debt to you. So your debtors, to calculate your debtor days, which is on average how long it takes for your customers to pay you, you take your debtors figure and divide that by your sales figure from your profit and loss, and times it by 365 for 365 days in a year. So on average, this company's customers are taking 26 days on average to pay them. So if they updated their terms of trade, for example, requested payment, sorry, the dog is under my desk. If they updated their terms of trade and requested payment within 7 days rather than 30 days, and they managed to reduce the debtor days by 5 to 21 days, then that means they would have an additional 13 or just under £14,000 cash injection in their business. So basically it's the number of days improvement means how quickly the money will get in your bank, or that money will get in your bank quicker. So that means that your business will get that money quicker. That'll improve your cash cycle. It'll improve the strength of your company. And then we can go on to inventory days as well. So again, this is when you have stock that you are holding. So it could be stock that you've brought in to resell. It could be materials that you've brought in to make your goods to then resell. So to calculate inventory days, you divide the inventory's cost, so however much it costs you to buy those products or raw materials, divide that by the total cost of sales, and then divide it by 365, and that gives you your inventories days. And as you can see in this example, it's 74 days. So that means it takes 74 days from the day you buy it until the day it gets sold and that money comes into your bank account. So that's 74 days the money is tied up in those goods, your stock. So some of the projects you can do is to work on a improvement strategy. So you can update your inventory process, you can reduce the amount of stock you have on hand at any one time. You could reduce, if it's materials that you're buying to produce your goods, it could be that you change the way you do that so that there's less wastage, there's less, it takes less material so that you can do it quicker, and therefore you can improve the amount of days that you hold that stock in stock for. I'm saying stock a lot, sorry. I'm hoping this is making sense and I'm not just waffling. Sometimes it's a lot easier for me to write it all down as we go, so it's a bit easier in person to explain this sort of stuff. But yeah, so if you can improve the amount of days that you have your stock in stock by just 9 days here, you can see that's going to give you an improvement on your cash bank balance of £7,860. So while this cash flow gain of nearly £22,000 for doing just these 2 improvements doesn't fix the solvency issue that we spoke about before, it does demonstrate how much cash can be saved by doing these little projects. And it could be a project that you do with your accountant, it could be something you do yourself with your team, but doing these little things can actually help you improve your business, the strength of your business, get that money in your bank quicker, because at the end of the day, that's all we want to do, is we want to get that money in your bank account quicker. So yeah, there's plenty of things you can do, and this is just 2 of those examples. Using your balance sheet to understand these figures can help you to improve your business. Right, so we're going to move on to the shareholder current account, which is also known as director's loan account or director's current account, which you should see on your accounts. And what this is basically is it records all of the funds that's introduced to the business or taken out of the business by you, the shareholder and director of the company. So it can help you to monitor your personal expenditure within the business. So if you pay for a lot of things personally from your business, they'll all get put into your director's loan account. And it maintains a record of, if there's more than one of you, who has put what into the business, who's owed what from the business. So yeah, so you can be able to see from here what your business owes to each shareholder if there's multiple, or what it owes to you as the sole shareholder. And if the account is overdrawn, it means that the person's taken out more than they've put in and now owes the company. And what you'll see our clients to see, and what a lot of people will do, is the director's current account will look as overdrawn, that you've taken more money out, as we put all your drawings throughout the year to it, and then at the end of the year we vote a dividend to cover that balance so that you're back in the positive, and that is what is recorded as your dividends for the year, and that's what you're taxed on. But obviously that all depends on making sure you've got enough profit in the business to repay, to have that amount of dividend. So if you've not got enough profit in the company to have a dividend at that level, it could be that you need to repay the business. It could be that we need to adjust your salary and put your salary higher to compensate. So understanding what goes in and out of your director's loan account and understanding the balance at the end of it will give you an indication of if you're taking too much money out of the business, or if you've got more money you can take out of the business. And if it is constantly overdrawn and there's not enough money, then it's something that needs to be addressed, and that's something that we look out for as accountants. on a quarterly basis, we're reviewing what's been taken out compared to what the profit level is, so that we can see if our clients are taking too much or if they've got surplus that they can take out, and then we can talk to them about strategies. If it is overdrawn, they've taken too much out, we can look at strategies of how to improve that, how to correct it. Or sometimes it's really lovely just to go to a client and say, actually, you can take a bit more money, you can go and treat yourself. Yes, they're going to pay personal tax, but it's really nice to be able to say to a client, especially if they've been working really hard, or you work really hard, but you know what I mean, if you're working towards a goal and you can see it's there and you can take that money out and go and treat yourself to that holiday that you've been working to, and so forth. Or if it's like you're saving up for a mortgage, being able to see that you've got those surpluses there where you will then be able to afford to pay yourself more, and therefore you will be able to afford to pay for the mortgage and things like that, is what we're looking at when we do things like this. So that's why we look at clients' goals, to understand what they want out of the business, and then we can see how their accounts affect the goals and how we can work towards those goals with using their accounts to understand where they're at and where they need to go. So let's take a look at a director's loan, and this won't be quite how you see it on Xero, but I've simplified it here so that you can understand a little bit more about how it shows. So yeah, we can move on. So you'll kind of see this is an overview. In Xero it'll be broken down, so you'll see the ins and outs individually, but as an overview, what you'll see is you've got your opening balance here. So at the start of this period, this company owed its shareholder, Mr. Doe, very original, John Doe, just over 29, just under £29,500. Throughout the year, he's introduced just over 2,000. So that could be not physically necessarily putting money into the business, but he may have had a couple of expenses that he's paid for personally throughout the year, or it could be his mileage. So he's paid for it, so it's technically funds that have been introduced to the business. But then he's taken out 9,600 or 9,700 almost, and you can see here that's taken out both in general drawings of 8,000, so that could be his monthly amount that's taken out, but he's also got a life insurance policy that's running through the business, so we've put that into the director's loan account because it's a personal expense that the business is paying for, so that gets added to his general monthly money that he's taken out to get a total amount that he's taken out throughout the year. So from here you can see the company now owes Mr. Oops, gone too quick, sorry. Now owes Mr. Doe just under 22,000. So this is the amount that the company can repay Mr. Doe without being any tax implications for the shareholder. If the company is solvent and has got plenty of money in the bank account, then they can be repaid. If there's not the money there, then it can just sit and it will stay as owed to the director as and when the company has the money to pay it. If that was a negative figure and the company was in profit and it had reserves, then we'd be able to vote a dividend to clear that, to bring that back down to zero or slightly positive. We always try and round it up. And that's how the dividends work basically. So throughout the year, you probably will see it as a minus figure, but at the end of the year, we'll look to turn that into a positive figure if there's enough money there. And as I said, throughout the year, we'll be checking this figure with all of our clients so we can make sure that there is enough money to cover that as and when the time comes. When a business is insolvent, like we've seen previously, the shareholder may then put more money in, so the funds introduced may be a higher amount, and it could be actual physical cash they've put into the money to cover some of the debts. But obviously that's not a sustainable long term, so if that is what the business owner is doing, then again it'd be noted within the director's loan account, and it's something that we can then look at and devise a strategy so it stops happening and the business covers itself. So that's the director's loan account. And then the last one I'm going to go through in more detail is the fixed asset register. And pretty much what it says on the tin, it's a register of all the assets your business owns. So, for example, vehicles, computer equipment, furniture, and so forth. And what it does, the fixed asset register, is it spreads the cost of your assets across their useful lives. So say a computer will last you 3 years, so it will spread the cost of that computer over 3 years, and that's what's shown in the profit and loss as depreciation. So the depreciation is that year's portion of the cost of the equipment. And what the fixed asset register does is it keeps track of how much each of your assets is worth on paper, which could be completely different to what they're actually worth if you was to try and resell them, but it's for your business purposes what they're worth on paper. And it's a really useful guide to determine when your assets need to be replaced, and then you can budget for that accordingly and say, right, well, these computers, for example, are coming up to the end of their life. And you can say, right, well, we're going to need to replace these, say, next month before they completely go kaput. Obviously, we know with computers, it's not always easy to plan like that, but it is really a useful guide to understand which computers could be needing replacing sooner rather than later, because you know how old they are and how much they're worth and everything. And it's also really useful having this asset register when you come to sell your business. If selling your business is something that you're looking to do, then when you sell the business, you sell the assets with it. So you would need to understand what the value of all the assets in the business are, as that will become part of the sale price when you do sell your business. So that's another reason for the fixed asset register. As with everything, we keep a record of all the fixed assets within Xero. So this is more of an older school style report, because I just wanted to explain to you how it works and what is shown in the fixed asset register, because Xero doesn't show you all the nitty gritty underneath. It literally just shows you the headlights, so to speak. So this is what in the background as accountants we will see. And the first column will list obviously all of the assets itself, and it will group them into the different categories, and it will have the initial cost. It will then show the opening value of the asset at the start of the financial year. So what this is as an opening value is the cost of the assets less any depreciation to date. So for example, the van, which you can choose top line one, it originally cost £22,000. It's already been depreciated £15,000, that's more, 14,000 over the last couple of years. So it's got another 7,000 left roughly in value on paper. So that value has been spread roughly over 3 years, £7,000 a year depreciation. So the opening value at the start of this year is a 22,000 less 2 years worth of depreciation. Obviously, that's very rough because those figures don't quite add up, but it could be that they bought it partway through a year and it's being depreciated. So that's what we mean by the opening value. The next 2 lines will show if an asset has been purchased or disposed of during that financial year. So if you come down to the office equipment, you can see the website has been put in that year and it's been capitalized as an asset. And websites can be very subjective as to whether or not they're an asset or an overhead. In this instance, in this example, it has been shown as an asset and it was purchased during the year. And you can also see that the software and computer and the iPad have all been disposed of during the year. So it could be they've either been sold, they've been literally disposed of, thrown away, or it could just be they've it's the last couple of pounds left, so they've just been written off and it's still actually within the business. It doesn't necessarily mean it's been literally disposed. It could just be the last few pounds has been written off just to tidy things up, but the asset is still within the business, but the cost of it has been spread over the time, so it no longer holds a value on paper because you've already used it within the business. Then you've got the rate and method of depreciation. And again, this is very accountancy, so there is a few different ways to spread the cost, depending on the type of asset. And I'm not going to go into full detail because I'm thrown so much at you already. I don't want to completely blow your mind. But there's different ways of depreciation assets depending on how they're used, the type of asset and things like that. So some assets would be used equally over the time in their life. Some assets are used more at the beginning, less towards the end. Like a car depreciates so much when you drive off the forecourt and less in later years. It then holds its value a bit more. So again, it all depends on what it is as to how the depreciation's worked out. And that, as I said, that's for us accountants to deal with. So don't worry about having to work all that one out for yourself. You've then got the depreciation for that year and your total depreciation so far in the life of that asset. Oops, I've moved the thing over. And then it will give you the closing value of your asset. So that's the opening value less the depreciation for this year. It's this one, which also works out to the cost less the closing appreciation, will give you the current value of that vehicle or asset. So if you did go ahead and sell that vehicle, this is what it's worth to you as a business. So if you sell it for more than that, you're going to create a profit on paper. If you sell it for less than that, you're going to create a loss on paper, which again is something else we can come to another time, but that can give you an idea of what you should be selling the asset for if it's something you do sell on in future. And yeah, and the closing value column as well is the amount that will show in your accounts. So this value here at the end, the closing value, is what will be recorded in your accounts at the end of the year, and that's what will give your business its value at the end of the year as well. So that's some of the key reports that you will see and be producing, or us producing as your accountant. And each, as you've seen, each report tells a different story about your business and it aids your decision making in different ways. So yeah, if you've got any questions about any of those, I know I've done a whistle stop tour and it may not make sense compared to your own figures. So if there's any questions, then please do either pop it in the chat box or drop me an email afterwards if it's something specific to your own figures, and I can answer the questions for you. What we're going to do now is we're going to move over to understand a little bit more about the difference between profit and cash. So this is something that we see quite a lot. So if this is you, you're not alone, but we see many business owners get quite frustrated that their bank account never reflects what it says in the profit and loss. And that can be quite frustrating and annoying, but it's essentially you understand the difference and why a high profit doesn't necessarily mean more cash in your bank account. So a profitable business, as we've all seen, can go out of business because it's starved of cash. It's not getting the cash in the bank quick enough. But alternatively, a business running at a loss can survive because it's got access to money from investors, business owner, or whatever. So you've heard the same many times, turnover is vanity, profit is sanity, but cash flow is the reality of a business. So let's just have a look at a few things here that would affect your profit and your cash. So VAT will affect your cash balance, but not your profit, because all the figures in your profit and loss. If you're VAT registered, is pre-VAT. Slight caveat, if you're not VAT registered, obviously your purchases will include VAT, but in general, it is your cash balance it will affect, not your profit. Loan repayments will affect your cash balance, but not your profit, because loan repayments or your loan initially doesn't have anything to do with your profit. Interest on loans, slides are not keeping up. Your interest on your loans will affect both your profit and your cash balance. So the interest, obviously you're paying interest every month with your loan repayment, but it's also an expense to your business. So that will show on both your profit and on the cash flow. And I'm not sure why this is taking so long and it's not catching up. And oh, there we go. Asset purchases will only affect your cash balance because assets don't show on your profit and loss. And same for asset sales. When you sell an asset, it will only affect your cash balance, not your profit. But your depreciation of your assets, we've just seen on the fixed asset register, will show in your profit and loss, but obviously not in your cash balance. So these are the things that you can see that even if your business has achieved a healthy profit, it wouldn't necessarily have any cash in the bank after paying tax, paying your loan payments, and buying new assets. So that could be why your bank balance and your profit is not matching up. After cash flow, business value is the next most important measure of your business. So part of knowing your numbers is understanding and measuring the drivers of your business value. So as we said before, it could be one of the drivers is the profit on your profit and loss. That is one of the drivers to establish the value of your business, but it could be a number of things, and for each industry it's different. It could be the monthly recurring revenue that you secured, it could be your revenue growth, it could be revenue per client, could be your sales, but your profit would definitely have some kind of effect depending on, your profit will definitely have some kind of effect with regards to your value, and that's in addition to the other things as well. I was trying to get my words out then to explain it. So it's important for you, if selling your business is something that you're thinking about in the future, it's important for you to understand what is the key driver for your business and the value of your business. And then that would then become one of your KPIs, your key performance indicators, to track and monitor to make sure it's going up, which is obviously what you want for if you're going to be selling your business. So yeah, I think I've probably pretty much just mentioned most of this. So to enhance the value of your business, you must develop and implement a clear plan for your organisation, your roles within the business, what you want out of it. Establish some cloud-based real-time reporting, which will then help you to have access to these reports so you can make the decisions that you need to do. Review and document your systems and processes so that you are making the most out of everything, you're paying the least amount you need to, and getting the biggest return on your investment of time as well as money. This is something that's really important if you're looking to sell, is reducing the reliance of the owner of the business. That will really make your business more valuable, because it will then be easier for the new owners to take over when the business is sold. So if, for example, you're in a service-based business where you are your business, no matter what the profit or revenues are of your business, if you sell it, you go, there's no business. So building your business so that other people can do the things within your business as well means that your business will become more valuable. And finally, identifying and managing risks of your business means that they can be mitigated before they become an issue, and obviously that will improve the value and the strength of your business as well. So I'm just quickly going to run through some things here that will help you to protect your business. So as we've seen throughout the webinar, the profitability, cash flow and value of your business all affect you personally. And if your business isn't profitable and doesn't have much cash available, then you won't be able to pay yourself to fund your desired lifestyle. But there are some other bits as well that you can do to protect your assets and your business, which I'll run through quickly. So you can set up, again, it's not coming through. You can set up your business as a company to limit your liability personally. So that's one of the biggest advantages of going from a sole trader to limited company. Consider who should be a director of your company, which assets are held by your company and which are held by you personally. So again, if you're looking to sell in the future, potentially you don't want your business to own your phone and your laptop, because when you sell the business, you have to give them to the new owners rather than keep them. So that's something to think of as you get nearer that stage. Ensure you have security over money you loan to other people. Consider an alternative ownership structure for high value assets. So for example, if you have a commercial premises that you use and you own, it may be worth moving ownership of that premises to a separate company so that it's protected. We see a lot of this with companies with property portfolios. They're held in separate businesses to the trading arm so that they're protected. Review your terms of trade and credit policies to ensure that you only provide credit to customers who are likely to pay you. Review your insurances to make sure you've got the protection you need. For example, do you have business interruption insurance, indemnity insurance, and do you have enough cover to ensure that the impact or any impact of your business on any adverse events is minimal as possible? Ensure you undertake financial planning to manage your wealth outside of the business, make your money work for you. And finally, planning for the future. Do you have an up-to-date will? Do you have a power of attorney? Do you have a plan for transferring your assets and your business to the next generation or selling? Now, this isn't an exhaustive list. There's many other things you can do to protect yourself and your business, but these are the main ways that you can protect yourself and your business going forward. And we can help with many of these either personally, or we can refer you to people who can. So yeah, we just want to make sure you're all protected and secure. So going back to the reports we've looked at today, what should you be looking at and when? So the reports we looked at are all the ones that are going to be in your accounts and that you will look at on an annual basis, but some of them you should be looking at more regularly. So the sales and the profit are the things that your profit and loss is something that you should be looking at weekly. Your wages, especially if you pay your staff weekly, you should be looking at that weekly to make sure that you're not paying too much than you've got coming in. What's owed to you and obviously what you owe out. So they're things that you should be looking at very regularly. More things to look at monthly, because they're not going to make sense throughout the year, would be your budget, your actuals. So what did you budget for the month? What actually happened for the month? How are they different? Why do they differ? This month versus last month, because the only comparison really should be with yourself last year, last month. Are you improving? Are you doing better than you did last month? I know with some seasonal businesses that may not be appropriate, because especially if it's like a Christmas business, January's figures could be completely rubbish compared to December. So obviously if you're a seasonal business, then maybe you won't want to be looking at that one, but definitely look at this year versus last year. That's one for everybody. And I also look at this month this year versus this month last year to see what the fluctuation is. And then also be looking at your tax estimate and what profit you've got available for dividends, so you're not taking too much money out of the business. And obviously the tax estimate, so you'll put money aside ready for your tax bill. So how does everything we've talked about today come together as best practice? Every business should use 3 essential tools, and these are 3 that I use every year, every month. A business plan, an annual forecast, and then some ongoing reporting and accountability. And the reporting ensures the numbers you want to achieve in your plan and forecast are actually being measured, and the accountability side looks at some kind of form of coaching, really, to look at why the numbers aren't matching up, what's going wrong, what's going right. And it's like some kind of a form of coaching, really, to understand where you're at and being held accountable as well, because it's so easy as a business owner on your own. We've got no one to be accountable to, no one to answer to. So having some accountability, somebody there who will hold you accountable, will help you and drive you forward. So knowing your numbers is just the beginning, as it allows you to improve them and ultimately achieve your goals for your business. I've just got a couple more slides left. Sorry, I've overrun a little bit. I got a bit carried away talking there. So where do we go from? My aim today is to help you take what you've learned and implement some positive changes in your business. So now's time for you to decide what you're going to do. Take a few minutes after the webinar to write down 3 actions or projects that you can do that will add value to your business. Potentially look at what problems you're experiencing in your business, identify them, and use them as an opportunity to create a project to fix them. So say money's not coming in as quick as you'd like, there's a problem, the opportunity is to have a project to look at why it's not coming in and then fixing that. So it could be that you need to change your terms of trade, it could be you need to offer more payment services, make it easier for people to pay you. Maybe you just need to chase them a bit more. But whatever it is, doing nothing right now should not be an option. So here's a few ways we can help you. Now you know what is best practice. This is how we can help you carry out that best practice. If you don't currently have a business plan, we can help you develop one. We can help you create a cash flow forecast, so you understand where your money is going every month, how much money you need to pay everything, especially with loan repayments. I know a lot of people deferred them, so potentially you've got loan repayments starting now from those bounce back loans or soon. For those of you who need to be held accountable, we can help with some coaching options or some management reporting, which comes with a momentum call. Management reports actually a really good way of being held accountable, but also reviewing and measuring where you're at on a monthly or quarterly basis. We can have a call with anybody who wants to discuss any further what they need from their business, how they can achieve it. Could be something that they can do for themselves, implement themselves. They're just not quite sure what it is that they need to do to get to where they want to be. So we offer complimentary meetings. And finally, we've got our brand new Money Confidence program, which takes what you've heard today a hell of a lot further. It'll be all about you and your numbers. A 6 or a 12-month program, depending on how quickly you want to go. We'll look at your own figures, understand what's going on in your business, identify what needs to be worked on, and then we will work on those issues or just work on building the value or strength of your business, whatever it is that you need in your business to really feel confident that you understand where your money's going, and obviously making sure that your money is working for you. Questions? Obviously, I'm conscious of time. I haven't seen any questions come through, but if anyone does have any questions and wants to drop us an email, it's hello@pinkpigfinancials.co.uk or DM us on socials, and we can answer any questions. Happy to answer any questions you've got on today. Sorry. We will send out a recording so you can watch it back, replay it. And again, if after you've watched the recording you have questions, then please just do email us, and we can help you there. We'll also send out our guide, which will take you through those reports again a little bit more in a different way, which might make more sense to you as well. So yeah, just want to wrap up with saying thank you so much for coming today. I know this is can be quite an overwhelming topic. It can be quite an overwhelming webinar. Any feedback you've got, because I think I've run these a few times now, and I'm starting to think actually there could be a little bit too much. It might be something that we need to break down a little bit more. So if there's any feedback you've got from today's session on how we can improve it, that would be really helpful. There is an exit survey, which I hope works, or you can just drop us an email as well. Any topics that you'd like covered in one of these webinars as well, please do send us your suggestions. So as I said, thank you so much for taking the time today. I hope you've got plenty of ideas there to ponder on and some clear next steps for your business, and I hope to see you at a webinar again soon.